sides to a really great financial future. Tom and Don are talking real money.
I still don't think Pshaw is a word. This is my Wordle this morning. It was terrible. The word was Pshaw. Pshaw! All of you will have done it by now. That is not a real word. It's a sound.
What's the Webster's Dictionary definition of that?
Actually, the only dictionary I have is the one on my computer, which is, I think, the New Oxford.
Pshaw. That's
Pshaw.
a 19th century thing.
It's like 1850 or something.
Yeah, I think that's right. Yeah, it's big.
An expression of contempt or impatience.
Yeah, impatience. Yeah, that makes sense.
First recorded in English in the late 17th century. I'm sorry, but that's not a real.
I did not before us. That's a long time ago.
I failed my Wordle today.
I'm going to start using that now because you brought it up, and see, by the way, how many of these people under the age of 30 will have any idea they will go. No. What?
Did he spring a leak?
Yeah, pretty close. They think that already anyway. So,
hello again. Welcome to Talking Real Money and Wordle and whatever the heck we feel like talking about from time to time. I'm Don. That guy's over there is Tom. And today we're going to talk about the children. We're going to talk about things you do for the children. How you invest for children. Back in the olden days, it used to be you just gave them a quarter for an allowance, and they did what they could with it.
Sometimes savings bonds too. That was
savings bonds. Oh my gosh, my kids still have a bunch of savings bonds that they do not know how to cash in because apparently you can't just take them to a bank anymore.
Just take them to the Department of the Treasury next time you're in Washington.
Right, which is fully staffed, I'm sure.
Oh yeah, they're waiting for you at the gate there. Sure.
Anyway, so it's savings bonds, and then we had the uniform gift to minors account,
which still exists.
Yeah. And then in some states, the uniform trust to minors account.
That's right.
UTMA.
We'll talk about those.
Then we started getting these educational plans, 529s. Then
Coverdell.
Yeah, the Coverdell plans. Mm-hmm. That was another education plan.
Yep.
Then we got recently the kid account.
Well, you still got the Roth IRA, custodial Roth IRA.
Okay, well,
too.
We're not there. Okay, that's true, but that's not. You can't really give money in that one. Your kid has to earn it,
but you can still be your money that goes into it.
Sure.
The goal behind today is to try to pull all these apart, and especially in light of the recent 530 accounts. Isn't that what they're known as?
Well, not in some circles.
I know. The current president gets to put his name on them for reasons I don't understand. But that's here nor there.
We're not. Don't do it to me again.
You're going to want to take the slings and arrows on this.
I'm the one who gets all the reviews.
So the point is to try to figure out, shake it all out, help, because people, it's very confusing. And I think throwing there
are a lot of options.
It's made it more confusing. So Let's start at the beginning, Don, because we're talking about the kids, and so we don't want to jump in halfway.
You know, they say the beginning is a very good place to start.
What is it? Trip to the moon starts with one step. And don't put me on some of the rockets they're sending up today. So let's just assume a couple of things. First of all, the division for me is between money you're trying to set aside for a kid or grandkid that is going to be used in the next 20 years, non-education, right? Then you got the education and then retirement. I think you need to break it up into those things to try to figure out. Because frankly, when you do that, the aforementioned UGMA or UTMAs, that's money that goes in after you've already paid tax on it. You're putting it into securities for them, right? You're buying an ETF, a mutual fund, whatever it is. But then when it comes out, when they turn 18, right? When that money
18
comes
or 21, it depends. It's age of majority. But they take ownership of it. They may not take possession necessarily, but that's on you. But if you don't tell them,
when they sell the securities and take the money,
it's their money. It's taxed at their rate.
There you go. Okay, so but those frankly. That should, for me, if you're going to do that, that's for like a car or house, I guess, or some other major expense that a young person might have trouble meeting. And I think in today's world, fewer and fewer people are putting money in those, right? I mean, that's kind of a
well, they've been
19th
certainly
century, 20th century. Pardon me.
It's still 20th. Yeah, they've been usurped. Really, they were originally the biggest usurpation was the 529 plan.
Yeah. So the UGMA, that's that. And you could still, by the way, I think you can still do a custodial like savings account, right? If you wanted to, you could open a savings account.
Well, that would be under an UTMA or UGMA,
okay,
though.
Still would be. Okay.
Yeah.
But that's, again, sort of the shorter term money. Then you move into the education part. Now, we mentioned 529s, but there's still Coverdell's out there, too. We favor the 529. Money goes in after you've paid income tax on it, right? The money grows tax deferred. Money comes out if it's for an educational expense. And by the way, that includes, is it grades after 6 or something? I mean, so you can use it for
you can use it for all manner of private education.
Yeah, that's right.
Even pre-secondary.
That's right. Yeah. So that comes out, and there's no tax on it as long as it's used in that for that purpose. And the added advantage, and we've discussed this on the program, the one that is, I think, absolutely huge, if you really want to give kids a head start, you can take $35,000 of the money left over from educational expenses, and over a 7-year period, put $5,000 in each year for that young person into their Roth IRA. So now you've taken money that was set aside for education, and you've moved it into a Roth IRA. They have a huge head start for retirement. I mean, a massive head start. I think I mentioned this at the retirement recently.
To me, of all the programs out there, the 529 has the greatest flexibility, the better options, a higher degree of control by those who made the gift, who created the account, who are the custodians of the account. That makes them really attractive. I mean, UTMAs and UGMAs, let's go back to those for a moment. I just want to kind of get those on the...
You're more familiar with those because you were a broker at the time.
Yeah, I want to move those to the back burner because the only big advantage to a UGMA or a UTMA is the account is owned by the child but managed by the adult until the age of majority. That means that any money that's made by the account is taxed at the kid's rate unless it gets into the...
So if there's like earnings during...
like dividends and things. So,
okay.
Yeah.
Dividends,
so
okay.
You may not have to pay taxes on those, maybe. Depends on how much. But there's a little bit of income tax arbitrage because the kiddie tax kicks in when the kids earn more than $2,700 a year. But if they earn less than $2,700 a year, that's essentially tax-free. But as we mentioned, the downside is lack of control when they become of age.
Yeah.
And how many of us were irresponsible 18-year-olds?
No. 21 maybe, but at 18 I was pretty good. But yeah.
No, I wasn't.
Okay.
So it's not the best thing. That's where the 529 starts to sound really good. Yeah. And because of by the way, you can put $7,500 a year into a Roth because that's the max contribution a year.
Is that what it is now? They always change that.
No, it's $7,500 now. So
okay, so $7,500 a year.
A year from that up to $35,000.
Yeah.
Right.
Okay.
Right.
Yeah.
So that's another huge advantage. That means the money doesn't all have to go to education. As a matter of fact, if it's less than $35,000, none of it has to go to education. It's a huge benefit.
Yeah. And I'll be doing that with my daughter because I'm going to make sure the $35K is left over.
Right. You're going to leave her a future.
Yep, exactly. So that's that. But then I think forgotten before we get to the Trump accounts is still the custodial Roth IRA. Now, remember, a young person has to have earnings of some kind, has to make money. Now, we could get into all the definitions. But I've seen people use lawn mowing money. I don't recommend that because the idea that 50 years from now, the IRS says, wait, you put in $300 in 2004 when you were 8 years old. Tell us about that money. I don't know if that could happen.
Yes, it could.
Maybe it doesn't. I don't know.
I'd rather not because it's the IRS. They can. Yeah. As long as it's within their statute.
The W-2 income, actual income from a job. That'd be my take. But so custodial Roth IRA, And as Don said, I guess you can go up to the 7,500 on that. And that money is going to grow tax-free for a very long time.
Let me just give you a number, just a sort of hypothetical number. No, it is hypothetical. Let's say you put that away and your kid has $35,000 in their Roth IRA now at age 25. Okay? 25.
Remember, I did this at retirement.
They're going to leave the money there until they're 65.
It's close to $1 million, right?
No. At 10%, which is the average annual return of U.S. stocks over 100 years almost. Well, we're at 100 now.
Yep.
That's $1.6 million.
Wow. Tax-free.
Free.
That's really, which is another reason I think all this should be tax, pay the tax, put the money in, let it grow, because I think it makes a lot of sense. But, okay, so that's
particularly
the custodial
when
law.
you're young. Pay the tax, put it away when you're young.
And this is, by the way, the 529s I've done for my kids and am now doing for my grandkids because I think it's a great advantage. For my youngest daughter, she's been an earner. She's already piling up money in her Roth IRA, so she's doing that. But let's move on to the topic du jour because this is the one that it's getting all the attention right now. It's getting money, and it's free money. This is the Trump accounts, the 530s, and if your child or grandchild was born between 2025 and 2028, you get $1,000 a year, right? Isn't it a year?
You get $1,000 a year, yeah.
Boom.
Free
from the government.
Free money from the government, but only if you're born in those 3 years. I mean,
and you're going to have to pay it back in taxes later because where's the $1,000? It's a whole other topic. But okay, then you can take from your parents, grandparents, employers, and save another $5,000 a year into those accounts. This is money that grows tax deferred.
Yeah,
now, I think the real advantage.
Really? I'm still, other than the free $1,000, I'm still having a problem finding an advantage there, particularly over the 529.
Yeah. Yes, that's true. But here's the thing. At 18, you can then begin the conversion process. Take that money that would be basically in an IRA and convert it to a Roth, pay the tax on it. Your tax rate probably pretty low at age 18 and start building up your Roth account using that money that you saved in the 530.
All right. But let's step back a moment. The 529 allows you to put $35,000 tax-free into a Roth IRA if it
from
hasn't been used for education, tax-free, no tax. The other one allows you to put it in a Roth, but you still have to pay tax. The only really big deal in there that makes it, because you can still do you can do a Roth, as you mentioned, a custodial Roth for your kid. So how is this any better? I don't see that it is.
Well, employers could put money in, and employers can't put money in a
Roth.
Kids Roth IRA or 529 for that.
Boy,
matter.
that just sounds like one of those.
And if you live in a zip code that's where the median income is 150 or less, Michael Dell will pop in another 250 for you.
Okay.
I mean, so is it at the fringes? Yeah.
Yes. Yes, it's at the fringes.
Here's the thing. Setting aside here's the thing it does do. It does get more people sort of in the market. Remember, they're going to invest this in index funds. And of all the choices, by the way, because I know somebody will write me and ask me, I would pick the Vanguard Total Stock, VTI, out of the choices that they offer now.
Yeah.
Rather than just the S&P.
You can't get VT.
I know. That's not United States of America.
Uh-huh.
Oh, good Lord. Anyway, so they all have disadvantages. You raise a great point, the 529, because then you have the retirement kicker at the end. You could
the 529 to me in terms of
pretty good.
All the aspects, control, investment options, spending opportunities, tax advantages, future retirement advantages. It's got all of this baked into one product.
Pretty slick.
That I hope they don't take away, because I think this is one of the best ways for parents to really set their kids up for one form of success or another. because it can be used for trade schools, it can be used for college, it can be used for retirement. That gives you so many wonderful options. So for me, it's the winner.
Yeah. And by the way, I'd be fascinated to see, and I won't be around likely to see it, that when these young people start turning 18, how much of the money stays in these accounts or gets converted to a Roth IRA, or how much just comes out and you're going to pay tax on that withdrawal, and you're going to pay the penalty, the 10% penalty.
Dude,
but
you
how
only
much
have to
of
make it into
comes
your
out?
80s to see if that works out.
A little more than that. Oh,
No,
18 years.
if they're
it's
18
pretty
years,
close.
you're it'll be
Closing
your
in on
late
70.
80s.
Yeah, let's be honest about that. I don't see myself getting 85.
I just
no, Paul Merriman,
probably because of that suspicious boat accident.
whatever accident it was.
I don't know how Tom fell off that boat and drowned. He's a great swimmer,
I
but he just
know.
went right to the bottom.
Never found him. Anyway, so I think that's good. So there's all these options. If this is important to you, and I agree with you on the 529s, Don, that's probably a really great option for most people.
All right, now, ladies and gentlemen, the moment you've all been waiting for, it's paper Q&A time. Tom has his big old stack of dead trees. Just
Every night I go to bed and say, it's going to start going down. And last night, people sent another 4 questions.
So we're not even keeping up.
No, we're not.
So we better try to do 4 questions today.
Yeah. All right. Let's go.
Just to keep up.
No.
Go. Start with the
Greg
first one.
Greg from Lake Mary, Florida. I'm not familiar with Lake Mary. Are
Lake
you?
Mary's very close to where we are. It's
Okay.
really close, yes.
Dawn and
Central
Dawn.
Florida-ish.
Writes Greg. Apparently I'm X'd out of this one. I don't get that, but that's okay. Been digging into where to
Two
put
guys named Don. That'd be confusing.
Some people like writing Ron and Don because that was a popular radio show, I guess, or something. And I don't care. Call me Hey You. I've been digging into where to put real money to work, and I think I've got one. Thesis: mega cap growth has run hard, so actual bargains now are quality value Buffett bargains. 2 ETFs do this systematically. MOAT, M-O-A-T, buys wide moat companies. I assume these are something's developed a product that nobody else can do without being a really great swimmer that you just mentioned. Only when they trade
to protect the castle.
only when they trade below fair value. The literal Buffett playbook.
Yeah.
That's MOAT.
Yeah.
Then he's got a second.
M-O-A-T. Hold on.
M-O-A-T.
I got to
Yep.
pull it up because I
Yep.
haven't done
Then
that.
he's got a second, which apparently is just about time for the barbecue. COWZ, C-O-W-Z, the 100 highest.
Is that
free-
the Chick-fil-A fund?
No, that's the anti-Chick-fil-A fund. The 100 highest free cash flow yield names, 18 PE and minus 6.4 FCF yield. And it's out of favor right now. Contrarian entry leaning cows for the entry. This is very complicated. But at the end of the day, he says, let's talk real allocation, who's in and how for how much. I probably wouldn't be in for either of these.
No, I wouldn't.
Frankly.
I wouldn't be in for either of these because a couple of reasons. One, they're very small portfolios. I mean, the COWZ is a 100 stocks. And they have a relatively high expense ratio. The COWZ fund, the Pacer U.S. Cash Cows, just companies that have a lot of cash.
Yep.
They have an expense ratio of 0.5% a year, which is a little on the high side. And then the other one, MOAT,
And are they buying and selling securities then too?
the 100 stocks.
But I mean, but the turnover in the fund, so things are going in and things are going out.
I don't know what the turnover
See, this is when people tell me, by the way, that's traditional active management of portfolio. Because somebody wrote me yesterday and said they looked us up and we're an active fund manager. I said, well,
I don't know that that's entirely
not
accurate.
in a
They sound
traditional standpoint.
They're
like this
rules
would be.
based, like Avantis and Dimensional.
Correct.
But they're rules based in a very specific, really tight way that, by the way, I don't know if there's any historical basis for this because I don't know that there is any robust academic research not that I can find
Supportable.
to support that these are any better than just buying a value portfolio, which you can get for a lot less money.
Yep.
The
And
MOAT
more
is also
diversification.
the MOAT is also 0.5%. And MOAT's portfolio is just 55 stocks.
Wow. So your whole portfolio is 155 stocks. That goes contrary to what we believe as diversification, diversifiers, and our portfolios are going to hold 10,000 plus stocks. So,
yeah, I mean, again, I'm not horribly against these. I'm not foaming at the mouth about these. They're not terrible funds. They're just a little on the pricey side. They appear, at least in the shorter term, because we don't have history, they appear to not provide any kind of outperformance that I can see, generally, over a long period of time. Again, I think we're just overthinking stuff. We're trying too hard to find a gimmick that will solve whatever perceived problem we believe exists.
Yeah. All right. And speaking of that, and you may be frothing at the mouth on this one, because
I'm sure one of these is going to get me.
Pensacola, Florida, Michael writes us. I figured since questions, comments were few, you'd be forced to play the Bitcoin segment card.
Oh, no.
By the way, when we were complaining about that. That has turned around dramatically. And thank you for all your questions. Although I feel you still lack real understanding of Bitcoin, I have to say I do appreciate you foregoing all of the nonsense about Bitcoin being a fraud, Ponzi, tulip bulb bubble, etc. Well, I still think it's a tulip bulb bubble. So fraud, I don't. But there is fraud that seems to occur more regularly with Bitcoin than it does with other securities. But that is my take. He continues, your most recent comments were much more measured. I would like to correct you, however, on a few things. Number one, Bitcoin IRAs are not new. I've had my Bitcoin holdings in an IRA for years. Isn't this counter to your points, folks, buy Bitcoin just to get rich quick? No, people
how could he have had it for
IRA to get rich quick.
How
all
long
the time.
could you have had it? It's not long term. We don't have a 20-year track record with Bitcoin.
Couple of years. Well, a couple of years. He says IRAs are going back. I don't know how long you've been able to put, because you would needed the security other than Bitcoins itself.
Here's what bothers me is that the Bitcoiners are much more hyperbolic than even we are. I mean, to use terms like store of wealth.
Well, we're getting to that.
Yeah, go ahead.
He says, number two, I'm by no means a youngster. I have the knees to prove it. I own and continue to buy Bitcoin because I do, in fact, consider it to be a store of wealth.
Yeah. Mm-hmm.
So a store of wealth is... I don't even like gold as a store. What would you consider a store of? I mean, give me one.
A bank account that earns 4%.
Do you expect your bank account to go up and down by 40%?
No, because it's a good store of wealth. You see, here's the problem with calling anything that has I can't call the stock market a good store of wealth. It's a good way to build wealth, but not a great store of wealth, because my definition of store of wealth is an asset that preserves purchasing power. Let me just bear with me. An asset that protects your purchasing power with some degree of proven reliability over time and something backing it.
The last two things do not fit Bitcoin, sorry to say.
Well, okay, no, none of them do. I mean, Bitcoin in just over a year, has lost half its value.
That's not a store of wealth.
That is not a store of wealth.
No. He does say, number three, go ahead. Yeah. He says, number three, Bitcoin is volatile. Yes, volatility does not equal risk.
Yes, it does. It does. Okay, then the stock, I'm sorry, let me just change my entire opinion of everything. I'm just going to the stock market is riskless. Okay, I'm being hyperbolic. Funny. I'm being hyperbolic. But wait, what is the risk if you own the entire global stock market? Come on. What is the risk if you own the whole thing? Can the whole thing blow up?
Sure.
Yes.
Yeah.
But if the entire economy blows up, what will Bitcoin that relies on computers be worth?
Less. A lot.
By definition, less.
He goes
at
on.
At least, you got a factory that homeless people can live in the factory. There's some value there. Go ahead. What else is that?
Well, okay. Going back, volatility does not equal risk. Now, as advisors,
that's just a lie. That is just a lie.
Are going to tell you they're wrong, because when things go up and down, they can't afford to hold them. He says, this is where I'm disappointed with you guys. You should know this. The Bitcoin fundamentals, he says, have never been stronger. I'm not sure what that refers to, the fundamentals of Bitcoin. I mean, maybe ask your friends that... Chat GPT.
What are
or
the
something.
Bitcoin fundamentals? What is?
I'm getting to that. Just are they
Did
issuing
he tell you what they
dividends?
were?
No.
I'm rarely. I've been a talk show host
Yeah.
for over
Lost
40
for
years,
words.
and I have been rarely at a loss for words.
Yeah.
What are the
as his business partner, I
fundamentals?
can tell you that's true, by the way. So
Fundamentals. Fundamental value. That is the what something is truly worth in any scenario. What is Bitcoin worth if all the computers in the world fail?
0.
Right. What's its value? What's its fundamental value then? I don't see the fundamentals because it's got as much fundamental value as a tank of compressed air. You can compress air and you can store wealth in a pressurized container, and then you can reuse that wealth to inflate tires and basketballs and, do things that you would do with like canned air that costs you money. So there is some value into storing air in a pressurized container. But the air inside that container has no fundamental value past your ability to breathe it for like 30 seconds before you die, if you don't have any more. Sorry.
Thank you for your comments.
These arguments are so
Been there,
blasted
done that.
spurious.
All right, let's move on to something else.
Spurious.
By the way, did you know that the Romans cut ice from the Alps and stored it underground so that they could serve ice cream to people at the Colosseum during certain events?
Wow.
Or
Okay,
gelato?
that was a great example of store of wealth.
Exactly. You imagine that, and they were telling us that the people serving it had to get it out to everybody before it melted, or you better hurry with that ice cream. On the day I was there, I was 95 don't get me going. All right, Gregory from El Cajon, California. Gents, love the show, and I'm an Appella client. I hope we don't get in trouble for saying that.
Well, he said it in the thing.
Okay, shout out to Tom for talking with me several times, and Sean Hoyt for being my guy. That's really nice, Gregory. Thank you for that. Before I start, Don, I don't record because I have a terrible radio voice. Well, nobody has Don McDonald's voice, so get over it. If you AI generate a voice for me, please make it a pleasant baritone. That's funny. All right, I did a little chat GPT research. In 1989, which is a year I can still remember, there were about 7,000 publicly traded U.S. companies. In 2026, 3,900. I think that's like 3,000 less. Mm-hmm. In the 1980s, there were 360 IPOs a year. 2026, that number is going to be about 220, so a third less. Mm-hmm. Third less stocks. Okay. Mm-hmm. In 2026, Chat estimates 250 to 400 companies will drop out of the stock market. Mm-hmm. These figures could indicate several things. Yeah, one trend suggests the stock market could become comprised of a few mega companies, or it could go away altogether. Another trend suggests the best returns may be shifting to private companies and, dare I say, crypto. Can you explain why you think the stock market is still the best place to invest long term? What piece of the puzzle I'm missing?
You're missing a lot of pieces of the puzzle, a lot, because you can only privatize so much. Your pool of potential investors in the private equity market is very limited, and it's limited just to really wealthy people. And while they have a lot of wealth, they don't have the resources of all of us combined, them and us, the regular wage earners who put money in our 401ks. There will always okay, I can't say that because I don't know anything for a fact, but I am very confident this waxes and wanes.
Yeah,
if
I agree.
People are looking for an opportunity. You see it happen. You see it happen. Well, I'll use a great example. Let's use a company like Comcast. It just came to mind. Comcast went out buying things. They bought Universal, which gave them NBC. They bought a lot of assets. They bought some wireless assets. They had all these cable companies. They did all this stuff. And they took all these companies that were publicly traded and rolled them under their umbrella and took them off the market, basically. Now they're rolling them back out again because they're spinning off NBC Universal again. Or NBC. So It comes, it goes, it ebbs, it flows, it's in, it's out, and you can't draw a straight line from any point, anywhere, anytime, and every time you do, you end up getting fooled by the market. My guess is that a lot of these private companies, which they've done in the past, will look at the value they're not getting, that they're not adding any value to their private portfolio because they're out of people to sell it to, and they're going, well, maybe we should sell it to the public market and see what we can get for it. And generally they'll get rich.
Yeah, why did companies go public? That was my take.
They go public to get money.
Yeah, to get
for the
my money,
that
your money.
Another great example, SpaceX. A lot of very wealthy people put a lot of private capital into SpaceX over the years, and they have been, over those years, chomping at the bit, trying to get Musk to take the darn thing public so that they can realize some of that wealth that they can't get it out. There's no way. They put the money in to SpaceX, but there was no way to take it back out. The only way to take it back out is either to find a greater fool to buy your share, and there aren't that many of those, or it's to sell it to the biggest greater fool there is, the stock market. And look at speaking of fools, look at what SpaceX has been doing.
Yeah, can we say failure to launch? The fact of the matter is, you need to look at businesses as entities developed by. You look at the two of us, right? Because we own part of a business, and at some point, Don's already done this a bit. We're going to want the money back from getting the business started, and
we have to find somebody to sell it to.
Correct. And the easier way to do that is, especially with a large business, is to go to the public markets. Right. So, yeah, there are fewer companies. Does that mean the market's not working? I think it means the market's working well. By the way, I don't know when we look back a long time from now that you won't look back at 2008 and some of the regulations that came out of all that convinced people they just didn't want to go public at all. There may be just people's attitude, and that could all change. Who knows? So I wouldn't count on that in the future. And yes, I do think public markets are a great way to get growth on your capital for all the reasons that we've stated many times on this program.
And by the way, the public markets still amount to trillions and trillions of dollars. Let's grab that last one, just the last one. I promise 4. Is it short? It's short, right?
No, it's very long.
Oh, well, then we won't do that one.
It's really
I can't do a long one. It's a
long
really long
one. I'm trying to figure it out.
Never mind. We'll do that for another day.
Yeah, it's
all right.
Really long.
You'll have to listen to the next show.
Please, if I could, some people get this and some don't. Some write, and we love all of you. I'll just put that out there first. I do. Truly. Appreciate it. But some people write me.
I love you, but
because some people write 1,000 words on, I'm thinking of this and then here's my portfolio. We can't do that on the show because that would be an entire program. Number 2 is, unless you really want to come on and discuss it, which we're probably not going to do because even then it's going to take too long, you really need to sit down and talk to an advisor because there's just things that are idiosyncratic to your situation that we cannot do on the program. So while you write these, sometimes I try to pull a little bit of here and out to see if we can answer it. But for the most part, those really long ones, you just need to talk to somebody else about it.
Listeners don't want hour-long podcasts, we found. Yeah. Generally speaking, the sweet spot is 20 to 35 minutes, somewhere in there. Oh, let me share a little invention with you. They've invented something that could solve that problem.
Yeah.
They call it a chair.
Oh, and by the way, speaking of that, back to the Coliseum, they're sitting on stones
Tom
all
just got
day.
back from the Coliseum.
I know. All day sitting on stones in 95-degree heat. Oh, my God. At least it was free. The emperor.
But they had ice cream.
They had ice cream, and they had parts of wild animals. So they not only killed wild animals on the floor of the Coliseum, they would then cook them for you and feed them. Yum. Would you like a piece of giraffe? Probably not.
That rhino was a little tough.
A little chewy. Tastes a little like chicken, but still not easy.
If you want to ask questions, go to talkingrealmoney.com, click the button that says Ask a Question or the microphone in the lower right corner to speak your questions for the Friday podcast. And again, you got a long one, you want somebody that you can sit down and talk to for a little while. Even if you never become a client, we have people that will talk with you and they won't charge you anything as long as you keep it below an hour. Well, even if you keep it above an hour, we'll just say,
no, hey. They'll talk to you. They will review your portfolio free, and they will talk to you.
And they won't put the full court pressure press on you.
No.
Okay? So do all that stuff. tell your friends about the program, and please keep listening almost every day as Tom, me, and you are talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.